ये घंटे क्लास है ना? ठीक
है। Hello my dear students, welcome to the English medium prep by Exampur and Bankpur. Today, as you have seen in the thumbnail, we are going to discuss what will be the impact of increase in repo rate by Reserve Bank of India. I hope all you are doing well and your studies is also going very well. Then before starting with the topic, before going to the repo rate, we have to understand what is monetary policy. What is monetary policy? Okay. So, first of all, you should know that there are two policies in a country which regulate the supply of money. Okay. There are two policies in a country which regulate the supply of money. The first one is monetary policy. The first one is monetary policy and the second one is fiscal policy. Fiscal policy. Okay. The monetary policy is announced by or reviewed by or prepared by the Reserve Bank of India. The Reserve Bank of India, while the fiscal policy is prepared by Government of India. Okay. So as you have seen in the thumbnail, we should first discuss what will be the impact of increase in the repo rate by the Reserve Bank of India on your EMI and the inflation in the market. Okay. So first of all, see the definition of repo rate. First of all, see the definition of repo rate. What is repo rate? It is the rate of interest at which Reserve Bank of India or RBI grants short-term loans to the commercial banks. Okay. It is the rate of interest at which Reserve Bank of India grants short-term loans to the commercial bank, and these banks grants loans to the customers. Okay. These banks grants loan to the customers, and if the Reserve Bank of India's repo rate increases, okay, the current repo rate is 5.90%. 5.90% is the current repo rate. Suppose that in wholesale market, the potato is available at 10 rupees per kg. Okay, it is in the wholesale market. It is in the wholesale market. Okay, the wholesale market potatoes are available at 10 rupees per kg, and if a retailer from whom you buy the potatoes sells the potatoes at 15 rupees per kg. 15 rupees per kg, it is the price in a retail market. It is the price in retail market. If the price in the wholesale market increases to 20 rupees per kg, then what will be the impact in the retail market? Okay, absolutely. There will be increase in the price in retail market of the potatoes. So this impact will be seen in the case of repo rate. Okay, I think you are getting the concept, and if you are not getting the concept, kindly comment in the comment box so that we can learn the topic very comprehensively. Okay. So repo rate is the rate of interest at which Reserve Bank of India grants short-term loans to the commercial banks, and these commercial bank grants loan to the customers. If the rate of interest goes up for the commercial bank, and then the rate of interest on the customers which they will give on the loans which they get from the commercial bank will increase automatically. It is called the monetary transmission. I think you have got the topic. Okay. So for understanding this concept very comprehensively, we should understand the monetary policy and how it works in the economy. So let's move to the monetary policy. What is the thing that monetary policy does? Okay, the first question that is asked in your exams, in the CGL exams or any other SSC exams or any bank exams, is that who prepares the monetary policy? Then the answer will be Reserve Bank of India. And who prepares the fiscal policy? Then it will be the Government of India. Okay, any policy which is related with the taxation of the government, public finance, public debt, it is known as a fiscal policy. So today's topic is the monetary policy, and we will learn the monetary policy very comprehensively so that you can attempt all the questions in your exam. So definition of monetary policy: the policy by which demand and supply of money, okay, demand and supply of money in an economy is regulated, is known as monetary and credit policy. I hope the definition is clear to all of you. Okay, so let's move to the next slide. And one question is asked in your exams: who decides the monetary policy or the rates in the monetary policy? So in earlier days, when RBI was established or up to the 2016, the rates were decided by the Reserve Bank of India governor. Okay, Reserve Bank of India governor has the veto power or veto rights that he will decide the rates of the Reserve Bank of India. But in 2016, a monetary policy committee was established, and this policy is entitled to decide the monetary policy rates or the Rapport rate. Okay, so there are 6 members. Okay, there are 6 members in this monetary policy committee, and 3 are internal members of the Reserve Bank of India and 3 are nominated by the Government of India. Okay, 3 are the members of Reserve Bank of India and 3 members are nominated by the Government of India. So the first question arises: who is the chairperson of this monetary policy committee? So absolutely the right answer will be the governor of RBI. Okay, the governor of RBI is the chairman of monetary policy committee, and the other 2 persons are: one person is the chairperson and the other person will be MD Patra. Okay, MD Patra, he is the deputy governor in Reserve Bank of India, and the third person is Rajiv Ranjan. Okay, third person is Rajiv Ranjan. And 3 persons are nominated by the Government of India. So these members are Asima Goyal, and the next one is Shashank Bhide. Okay, and the 6th member is Jayant Verma. Okay, Jayant Verma. So you should remember these names so that whenever they were asked in your exam, you can answer this question very easily. Okay, there are 3 members come from the Reserve Bank of India and 3 members are nominated by the Government of India. If there is a tie in deciding the policy rates of the Reserve Bank of India, then who will be the deciding person on the rates of interest? So in the case of tie, the decisive vote will be of chairperson of the Reserve Bank of India, that is governor of RBI. Okay, let's say that 3 persons says that the rates should be increased. Okay, the rate should be increased, and 3 persons says that the rate should not be increased or should be stable as it was in the previous fiscal or previous monetary policy. Okay, so in this case the decisive vote will be of governor of RBI. I hope this is all clear to all of you. What is monetary policy committee and how it works, okay, and what is the function of monetary policy committee. Okay, so a question that is asked in your exam, what is that? What are the objectives of the monetary policy? If you go through the preamble of Reserve Bank of India, then you will find that the objective of the monetary policy is to maintain price stability. Okay, price stability means there should be a price of commodities which is affordable to the all customers, okay, who all are living in India shall be entitled to get the food and their needful objects. Okay, so there should be a healthy inflation that will bring growth and employment in the economy. Okay, so the first thing is price stability, that means that there should be no inflation or a healthy range of inflation in the economy. And the second one is that to promote growth in the economy. Okay, what means the growth? Growth here means that there should be increase in GDP. There should be increase in GDP. If the production increases, then the GDP increases, and if the production is higher and higher in upcoming years, then it will bring prosperity to the country and also it will bring employment in the economy. Okay, so there are basic three things which shall be kept in mind while deciding the monetary policy rates. What is the first thing? That inflation should be in a range that will bring economic growth to the nation, and there should be higher level of employment in the economy, and there should be a higher level of growth in the economy. Okay, let's move to the next slide. And there one question is asked, what are the tools in monetary policy? What are the tools in monetary policy? So there are two tools, that one is quantitative instruments and other one is qualitative instruments. So let's begin with the qualitative instruments. So first one is selective credit control. What does it mean? What does it mean? You have heard that marginal requirement. Okay, so what is marginal requirement? Let's see it with a very fundamental example. Suppose that you go to a bank or a lender, okay, and you give him 100 rupees gold, okay, 100 rupees gold. If you have given a gold object which is valued at rupees 100, so when you will ask him to give some money, he will not give pure 100 rupees or 100 rupees equal to that amount. He will give to you 80 rupees, okay. You are placing a gold object which is valued at rupees 100, which is valued as rupees 100, and he is giving you rupees 80 only. So the 20 rupees is the marginal requirement. Are you getting? So the 20 rupees is the marginal requirement in this case. And rationalizing the credit. You have heard that a scheme, the scheme name is KCC, Kisan Credit Card, okay, and you have heard the scheme of priority sector lending. In the priority sector lending, the Reserve Bank of India decides what should be the rate of interest to particular sectors of the economy and what amount of loan is given to this sector. So this is known as rationalizing of credit, and other one is moral suasion. Banks are the axis of the economy and they should grant loans to the needful so that it will bring prosperity in their life. So it is the moral responsibility of the bank to give of finance to those persons who are in need of money. So it is the moral obligation on the bank. And if a bank does not follow the guidelines which were circulated by the Reserve Bank of India, then there will be a direct action by the Reserve Bank of India. You have heard that this bank is penalized with 5 crore rupees, this bank is penalized with 10 crore rupees. So this is the direct action which is followed by the Reserve Bank of India, and in the worst case, the license of the bank can be cancelled by the Reserve Bank of India if they does any blunder in the economy. Okay. Next one is quantitative instruments. So what is the quantitative instruments? Those instruments which directly affect the quantity or the supply of money in the economy which is circulating in the market. Okay, so these are the quantitative instruments. So there are further categorization of quantitative instruments. One is direct instruments and the other one is indirect instruments. Okay, so there is one cash reserve ratio and other one is statutory liquidity ratio. Indirect instruments, there is liquidity adjustment facility, Repo, reverse repo, and bank rate, marginal standing facility, open market operation, and standing deposit facility. So these are the indirect instruments which are described in the tools of monetary policy. So here comes, what do you mean by cash reserve ratio? So as you seen in the thumbnail that the Reserve Bank of India increases the repo rate. Okay, so repo rate is increased by the Reserve Bank of India. Then what will be the impact in the market? It will be the banks will give more interest on the money which they take from the Reserve Bank of India. Okay, so in the case of cash reserve ratio, you should understand the word NDTL. What do you mean by NDTL? NDTL here stands for net demand and time liabilities. Net demand and time liabilities. The money which a bank gets from the depositors is known as, majorly known as net demand and time liabilities, because this money is arrived here by the demand deposit and time deposit, and both the deposits are liabilities to the bank. Okay. So if a bank have 100 rupees NDTL, so it have to maintain a reserve of at least, it have to maintain a reserve of 4.5%, maintain a reserve of 4.5% with the Reserve Bank of India in cash form only. It is known as cash reserve ratio. I hope the definition is clear to all of you. I will repeat the definition. It is the ratio of total deposits. It is the ratio of total deposits a bank. It is the ratio of total deposits a bank which maintains with the Reserve Bank of India in cash form only. Okay. So here the point to be understood is that the reserves are maintained in cash only. Okay. And with whom? Then the answer will be with the Reserve Bank of India. Then what will be the impact on the lending capacity of the bank? Okay. So if this is the total amount which a bank have to maintain with Reserve Bank of India, then it will have the 95.5% money or the 95.5 rupees in with itself to lend to the customers. Okay. If the rate or the CRRs increase, then how it will impact? Or if the rate or the CRR is decreased, how it will impact in the market? Okay. So if there is decrease in the rate, suppose that the rate is decreased to 4.00%, so the lending capacity will be of 96 rupees to the bank. So how it will impact in the market, or how it will you see in the bank? So lower the CRR means that if the CRR is lower, then the liquidity of the bank is higher. Earlier the bank is having only 95.5 rupees and now it is having 96.00 rupees. Means 0.5% increment in the lending capacity of the bank. Okay. So the money which a bank will have, it will surely go to the customers. And in the case of vice versa, higher the CRR, if see that the rate is increased to 5%, then how it will impact in the market? Earlier the bank is having 96 rupees and now it is having 95 rupees. Now it is having only 95 rupees. So there is decrease of 1% or 1 rupee in the lending capacity of the bank. So you will see that lesser availability of lending, lesser availability of total lendable funds of the bank. So you will see that in comprehensive we can say that during inflation is due to the higher supply of money or the higher purchasing power of the customers. So during inflation the CRR is increased. Getting that? CRR is increased to reduce supply of money. You should remember, to reduce supply of money. And in the case of depression, or you can say recession. Okay. In the case of recession or depression, you will see that the government or the Reserve Bank of India is increasing the supply of money. So CRR is decreased. Okay. Then how it will impact in the economy? Increase in supply of money. Okay. So nowadays you can see that the decadal high of inflation is seen in almost every country apart India. India is going very well, India is performing very well in terms of inflation. The government is controlling the inflation, and in terms of the economic growth, India's economic growth is expected to grow at 6.8% as per the record of IMF in FY23. And as per the records or the estimation of the World Bank, Indian economy will grow 6.5%. So you can see the data of the world and compare it with the India, then you will find that the India is performing very well among whole of the nations in the world. Okay, so government is, or the Reserve Bank of India is kept increasing the repo rate or the reducing the supply of money. So what is SLR? Statutory liquidity ratio. It is known as SLR also. It is known as SLR also. Okay. So it is the minimum percentage of deposit, or we can say that it is a total amount of deposits which a bank maintain with itself. In earlier concept, the money is maintained with the Reserve Bank of India, and in the concept of SLR, the money is deposited or reserved with the bank itself, and they have the option. To maintain the reserve in gold, cash, or any other liquid assets. Okay. So current SLR is 18.00%. The same concept is followed here also. If the SLR is increased, supply of money will decrease. So the SLR increase is opted when the inflation is soaring very high, and in the case of recession or depression, the SLR or CRR is decreased, so that the supply of money can be increased in the economy. Okay, so let's move to the indirect instruments of the Reserve Bank of India. So here comes the liquidity adjustment facility. Liquidity adjustment facility is the window of the Reserve Bank of India, or a facility of Reserve Bank of India through which it injects or absorbs the liquidity from the economy or market in a day. Okay. So what is repo transaction? Repo here refers to repurchase agreement. Okay. Repo here refers to repurchase agreement. What is repurchase agreement? Suppose that this is a suppose this is a stylus, and this stylus is marked at ₹100. Okay, the stylus market value is 100 rupees, and if I went to you and ask some money, then you will not offer 100 rupees for that. Okay, and if you give me 80 rupees for this stylus, and I make a commitment to you that I will repurchase this object and I will give you 85 rupees. So there is a benefit of 5 rupees to you also, and my benefit is that I have no money to invest or to do my work, and I got money from this object of mine. Okay, so the same concept is followed by the Reserve Bank of India. Commercial banks. Commercial bank has government securities with them, and they mortgage or keep this securities with Reserve Bank of. They keep these government securities with Reserve Bank of India, and Reserve Bank of India gives money to the banks, and the same money goes to the customers or in the economy. Okay, so the Rapport transaction is a liquidity injection transaction, means that in Rapport transaction the supply of money is increased. Are you getting? The supply of money is increased in liquidity injection. Okay, so the rate at which this transaction, the whole transaction is followed or processed, is known as repo rate. Okay, so what do you mean by repo rate? Repo rate, I already defined you that it is the rate of interest at which Reserve Bank of India grants short term loans to the commercial bank, and if the rate goes up, the commercial bank will get dearer loan, okay, and they will grant dearer loans to the customers. So it will automatically impact on your EMI, because if you take loan of 100 rupees, okay, if you get a loan of 100 rupees and you give 8 rupees interest on it, and in the case of increased repo rate, when commercial bank are getting dearer money from the Reserve Bank of India, and they are asking you that if you ask 100 rupees from us, we will charge 10 rupees from you. So what you see in this case, that there is an increase of 2% interest in your EMI, so equated monthly installment. So you will okay, so you will give more interest on your money. So it is a tool to reduce supply of money in the market. So let's discuss some more concept. The concept here is reverse repo transaction. When the banks have surplus money, and they did not have customers to whom they can grant loans, and in that case they will keep their surplus with the Reserve Bank of India, and Reserve Bank of India will government securities to the commercial banks. In this case, the money which shall be in the market, but it had gone to the Reserve Bank of India. So in this case, the liquidity is absorbed. Okay. So this is known as reverse repo transaction, and the definition of reverse repo rate is, it is the rate of interest at which commercial banks parks their surplus with the Reserve Bank of India is known as reverse repo rate. Okay. Move to the next thing. What is open market operation? Avan Tariq, good evening to you. Okay. What is open market operation? Open market operation is the sale and purchase of government securities. Purchase and sale of government securities in the market. And what will be the process in the supply of money? So when the government of India, Reserve Bank of India sells the government securities in the market, okay, suppose that I have this stylus and I sell it in the market, or I sell it to you. So in this case, this marker is bent to you, and whatever money you have, you gave to me. So in the case of you don't have money to purchase in the market. Okay. So whenever the sale of government securities begins in the market, whenever there is sale of government securities in the market, okay, there will be liquidity absorption. Okay, liquidity absorption. And when it is followed, so you should remember that in the case of inflationary economy, okay, government securities are sold by the Reserve Bank of India to decrease the liquidity in the market. And when the inflation is controlled and the economy needs more money to be invested in the economy so that higher level of growth can be achieved. So in this case, government securities are purchased. Okay, purchase of government securities. When the government securities are purchased and I purchase this marker from you, or stylus from you, I will give you money, and when you have money in your pocket, you will go to the market to buy things. Okay, then you are demanding more goods and services. Okay, when demand of more goods and services is in the market, then it will be transferred in the production process. So the production is also increased. Okay. So there is liquidity injection. Okay. So you should remember that open market operation is the process in which Reserve Bank of India purchase and sell government securities to inject or absorb supply of money or absorb money in the market. I think the concept is clear to you. Let's move to the questions which are asked in your exams. Okay. So here comes the repo rate. Here comes the repo rate. So you have also seen in the thumbnail that what is the impact of increase in rates or the policy rate by the Reserve Bank of India on your EMI or equated monthly installment. So which of the statements gives an accurate picture of the effect of the increase in the repo rate? What will be the impact of increase in repo rate? So kindly give the answer. If you have understood the concept, kindly give the answer in the comment box. The supply of money in the economy will, money in the country will decrease. The next option is the supply of money in the country will increase. The supply of money in the country will increase initially and then decrease. And the next option is there is no effect on the money supply in the country. So I have already told to you that if the rate of interest charged by RBI is 5.90, okay, it is the repo rate. So it is the rate of interest charged by Reserve Bank of India. And when bank comes in between, they have also their expenses. Okay. There comes the concept of base rate. What is base rate? It is the minimum rate of interest. It is the rate at below which no commercial bank will grant loan to the customers. Okay. So as the repo rate increases, the base rate of the bank will increase, and the base rate for individual bank differs. Every bank has different base rate because every bank has their operational capacities. Okay. So some bank have different operational capacities, some bank has more employees, some bank have more expenses to incur. So the base rate will increase, and then base rate will increase, then what will be the impact? The EMI or interest is increased. So the people who are available in the market, or they are going to purchase a car or a new car, and they are giving more interest on their loans to the banks, they will defer their plan for the next Deepavali. Okay. So I think you have got the concept. So the EMI will be dearer to the customers. So there is no effect on the money supply. It is absolutely wrong. The rate is increased, then the supply of money is decreased. The supply of money in the country will increase initially and then decrease. So this is totally wrong. How? Not increase initially, it will decrease. The B option is supply of money in the country will increase. No, not at all. It will not increase. If the rate is going cheaper, then the more and more money will going to be injected in the economy. So here the correct answer is the supply of money in the country will decrease. Okay. So these are the practices. Increase in the repo rate is always followed in the inflationary economy. Okay. Inflationary economy. I think you have got the concept. Let's move to the next question. Here comes the next question. Read it out loudly. Which of the following steps that the central bank will take to increase the overall availability of the credit? So in this question, the concept is going to be discussed that increase in the overall availability of credit. Okay, supply of money is going to be increased in this process. So what should be the step of the central bank or the Reserve Bank of India? It will sell the government securities in the market, it will buy government securities from the market, it will raise the cash reserve ratio, it will raise the repo rate. Kindly give the answer. What will be the correct answer here in this question? Kindly give the correct answer here in the question. So we are going to increase the overall availability of credit in the market. So we are not going, or Reserve Bank of India will not going to sell the government securities in the market, because whenever the Reserve Bank of India sells the government securities in the market, the supply of money is decreased. The same concept is followed in this stylus. If I sell this stylus to you or in the market, then the supply of money will be decreased, because you have money and you give it to me. It will buy the government securities from the market, it will raise the cash reserve ratio, it will raise the repo rate. So this is absolutely wrong. To increase the supply of money, the repo rate should be decreased, so that the base rate is decreased, or the interest that will be charged on the commercial banks loans from the RBI is cheaper. So it is also wrong. It will raise the cash reserve ratio. When a bank has 100 rupees with it, okay, when a bank has 100 rupees with it and the CRR it maintains what? 4.00%. Okay, this is not the actual rate. This is not the actual rate. Bank has 100 rupees, that it is known as NDTL, and if the SLR is 18.00%. Okay, so the total money that is reserved is 22%. Then what amount of money is left with the bank for lending? So the answer is 78 rupees or 78%. Okay, 78 rupees are left with the bank that will be lended in the market. And if the CRR is increased, then what will happen? Suppose that in the case of 4%, the rate is increased to 6%. Okay, the rate is increased to 6% now. So extra 2% will be maintained with the Reserve Bank of India. Then here the available money with the bank will be 76 rupees. Okay, 76% or 76 rupees. So in this case, the supply of money is decreased. So whenever the CRR or SLR is increased, then the supply of money is decreased in the economy. Okay, the lending capacity of the bank will decrease. So it will be wrong option. It will buy government securities from the market. So it is the correct option here. It will buy government securities from the market. Okay, let's move to the next question. Which of the following is a step that the central bank will take to encourage greater investment in the economy? Okay, what is the objective of investment in the economy? What will be the objective of investing more money in the economy? So more money is invested to increase growth in the economy, okay, and provide employment in the economy. When people didn't have money with them, then they will not invest in the market, or they will not purchase goods and services from the market. Then the growth of the economy will be hampered. And if the growth of the economy is hampered, then it will impact the employment opportunities in the country. Okay, so when the more investment is in the economy, then there will be more growth and there will be more employment in the economy. So in the case increase in investment in the economy, it will increase the cash reserve ratio. This point is absolutely wrong. We have discussed the cash reserve ratio very well in the previous slides. It will reduce the cash reserve ratio, it will increase the bank rate, it will look to sell the government securities in the open market. Okay. Whenever the government of India or the Reserve Bank of India sells government securities in the open market, then the supply of money is reduced. Okay, the supply of money is reduced. You should keep in mind. Supply of money is reduced. Okay, it will increase the bank rate? No, not at all. Whenever the bank rate is increased, bank have to give more interest to the Reserve Bank of India, and they have to give more interest to the Reserve Bank of India. They will avoid taking loans from the Reserve Bank of India at that particular time. And here the B option is, it will reduce the cash reserve ratio. This option is absolutely correct. This option is absolutely correct. Okay, how it will impact? Suppose that bank has 100 rupees and they are making a reserve of 6%, but now the CRR is reduced. Okay, CRR is reduced. Earlier the bank is having 94% or 94 rupees, and now they are having 96 rupees with them. So we can say that bank has more funds to lend in the economy. Let's move the There is some information I have to discuss with you. I hope you have all downloaded the Exampur app. If you have not downloaded the Exampur app, kindly go to the Google Play Store or Apple Store and download the app from the Google Play Store. Then after downloading the app, you have to register on the app, and after registering you will get job alerts in this application, because if you want a job, then you have to be very alert what are the upcoming vacancies in the market and what are the ongoing vacancies in the market or in our country. Okay, so whenever you go in this app, you will find unlimited quiz practice. Okay, unlimited quiz practice. There are a lot of questions available in this app, so you can go to the quiz block in this app and you will find unlimited quiz. And in this same application you will find free previous year solved questions. Okay, because if you are going to give a test, then you have to be prepared of the pattern of the exam. So how you will get the pattern of the exam? So you have to be very attentive, very alert to the pattern of the exam, and the pattern of the exam will be available in the previous year papers. Okay, there are also scholarship test or live test available in the app, and after availing this All India live test, you will able to get All India scholarship. By the scholarship you can purchase the courses on this app, or there is monetary assistance to you. There are free PDFs, structured paid courses are available. Structured paid courses are available on this app. You are getting the YouTube classes on the YouTube, but if you want to purchase any structured course in which you have a very well defined course plan, what you will get on which day, okay, and if you want these kind of PDFs of the board PDFs, then you have to purchase the structured courses and you have to pay some little amount of money, not very large amount. There is a meager amount you will be charged. So this is the features of application. Okay, so here is another announcement. We are going to launch a officer batch. We are going to launch a officer batch. Okay, what will be the fees? Everyone is asking. You will be charging very much fees. So the fees is 1099. 1099 after applying the code of CGL 70. After applying the code of CGL 70, you will get this course at 1099 rupees. Okay. After purchasing the course, what you will get? What you will get? You will get live classes. There is no concept of recorded classes on Exampur. You will be getting live classes, and the live classes, benefit of live classes is that you can clear your doubt in real time, okay? And you will get the PDF notes. You will get the PDF notes or the panel PDFs in the application, okay? And you will be having a structured study plan, because on YouTube you are not very much serious. You will get practice sessions. You will get practice sessions. There are sectional tests, there are full length tests, there are subject tests, okay? There are small 40 to 50 questions test, so that you will be able to tackle all kinds of problems which you will going to get in your exam, okay? And there is a test series concept on this course, yeah, or in this course, okay? So one thing you should keep in your mind, that you will have to apply the code of CGL 70, okay? You will apply the code of CGL 70, then only you will get the discount, and the fees is 1099. Otherwise you will be charged 3999, okay? So you should keep in mind, otherwise you will be charged more than other students. So I hope you have enjoyed the session. You have knowledge of repo rate, what is the impact of increase in repo rate, and what is the impact of decrease in repo rate in your economy. Always remember one thing, that if the market is deflationary, okay, the market is in recession, the market is in recession, okay, recession or depression. So to cope up with the situation of recession or depression, there needs to be increased demand, okay? To cope up, what should be followed? What should be followed? Increase in supply of money, okay? Increase in supply of money. So you have seen in the time of COVID, you have seen in the time of COVID, or you have seen in the recent press release of the International Monetary Fund, they have very clear view on the India, that India will be going to perform very better than other economies, because in the time of COVID, the direct monetary transfer in the accounts of the citizens of India helped in the increase in supply of money, and when the supply of money is increased, then the demand of goods and services is increased, and the demand of goods and services is increased, then what will impact? What will be the impact? What will be the impact? Impact is increase in production, okay? Increase in production, and thereafter what will be? Increase in GDP, increase in GDP, or we can say that increase in increase in employment opportunities. So both things I have made very clear. I have covered the topic very comprehensively, so that whatever the question is asked in the exam, what the government will do, or what the Reserve Bank of India do in the situation of recession or depression, they will increase the supply of money, so that the demand of goods and services is increased, and if the demand of goods and services is increased, then increase in production, and increase in production, that will increase in GDP, and it will increase in the employment opportunities, and if the people have employment, then they will get money in the pockets, and they will go to the market, and they have money to buy something, okay? So I hope you all have understood the concept very clearly. So let's end the class. We will meet with next very trending topics which are going to be asked in your exams, and I will be covering these topics in your exams. And also don't forget to come in 8 AM current affairs show, 8 a.m. current affairs show. In this session, we are discussing the current affairs or daily current affairs, which will really help you cracking your exam. Thank you for coming and joining me. All the best and keep smiling, keep healthy. Bye bye.